Are you worried about the future of the housing market? Investors and homeowners alike have started to panic as real estate prices continue to drop. But what is really causing this? In this video, we'll look at the facts and dive into why the housing market is changing and what changes we can expect in the near future. Welcome to Serious Coinage. Today, we'll dive into the facts about the current housing market, analyze the history of previous crashes, and hear experts' opinions on where the market is heading. But before we do, make sure to hit the notification bell and subscribe to stay up to date on the world of economics. Let's get started. Last month, Elon Musk, the multi-billionaire founder of Tesla and owner of Twitter, tweeted this prediction: commercial real estate is melting down fast. Home values next. Many started to question, will the housing market crash in 2023? To answer this question, we'll take a deeper look at recent data from developments in order to understand how their changes will impact us as investors in 2023. First things first, the year is 2023, not 2021. Houses are no longer receiving multiple offers and selling for thousands of dollars above the asking price within hours of hitting the market. However, the US real estate market remains robust. It's simply no longer bizarre. Moreover, insanity merely adds stress to the process of purchasing or selling a home. Due to rising mortgage rates and rising property prices, which together continue to exacerbate the housing affordability dilemma, the buyer-seller standoff remained unstable due to continuing inflation, bank sector turmoil, the debt limit drama, and an oncoming recession. Affordability and supply are weighing on the housing market. The dramatic increase in mortgage rates, which have only slightly decreased from their top of last year, has been followed by the surge in property prices. Given the price volatility and the fact that last summer saw the start of the highest inflation rate in 40 years, some customers might still be experiencing some sticker shock. The average 30-year fixed mortgage rate at present is 6.91%, according to Bankrate's most recent data. However, inflation slowed down in May to a new average of 6.57%, and it appears that it will continue to go down in the following months. Additionally, it's the first time in the past 2 years that wage growth has surpassed consumer price inflation, raising the general quality of living. There was fear that the collapse of Silicon Valley Bank, SVB, Signature Bank, and First Republic Bank might cause financial contagion among other banking institutions. Moreover, some specialists of the property market believe this recent wave of bank failures is just the beginning. According to Ken Rosen, chairman of the Berkeley Haas Fisher Center for Real Estate and Urban Economics and founder of the real estate market research business Rosen Consulting Group, the main issue is that regional banks, smaller banks, have been the main source of money for real estate lending. These small-scale financial institutions are extremely important to the system, as a portion of their portfolio is made up of everything from residential to commercial real estate loans. For that reason, some experts caution that the real estate business may be more significantly impacted than people think by the fragility of the local banking systems. The debt ceiling is the maximum sum of money that the US can borrow in order to pay its debts. The United States had to raise the debt ceiling in 2023 in order to stay current on its financial obligations. On June 3rd, President Joe Biden approved a bill raising the debt ceiling, allowing the government to keep borrowing money to pay its obligations. Zillow's predictions indicate that the housing market would be significantly impacted by debt defaults. Home sales could fall as much as 23% in the month after a debt default when compared to baseline forecasts without defaults. By the end of 2024, property values may also be 5% less than expected in a scenario with no default. These forecasts draw attention to the possible harm that could be done to home buyers and home sellers alike. History tells us that the US housing market is the first fighting playbook in the Federal Reserve's plan to curb inflation. The FED starts an upward pressure on mortgage rates. Due to high mortgage rates, home sales decline and home builders start to cut back. That's precisely what happened last year. The Fed increased interest rates, mortgage rates rose, and the US home market entered a classic housing slowdown. In comparison to its free fall in the second half of 2022, the U.S. housing market appears to be stabilizing as of spring 2023. The improvement in new home sales, however, is insufficient to counteract the negative effects of the housing collapse on the economy. However, since the Federal Reserve's June meeting, when it put a halt to rate increases, mortgage rates have somewhat decreased. Long-term mortgages, like 30-year fixed-rate mortgages, are indirectly impacted by Fed rate increases. Fed watchers sense that recent stronger-than-expected data on employment and personal consumption expenditures, together with persistently rising inflation, may encourage the Fed to proceed with future rate hikes rather than continue its current protracted pause. These conditions are all still exerting pressure on the housing market, which is still a mixed bag. The most recent house price index, HPI, from the Federal Housing Finance Agency, FHFA, indicates that home prices increased 4.3% in Q1 2023 compared to Q1 2022, with the index ultimately reaching a record high of 398.0 in March. The FHFA HPI is a group of home price indexes that tracks the worth of single-family homes in all 50 states and more than 400 cities using data going back to the middle of the 1970s. In a report published in 2022, the Federal Reserve Bank of Dallas noted signs of a brewing U.S. housing bubble. The report concluded that although the rapid rise in housing prices does not suggest a bubble, there are still other important elements to take into account. Among the economic causes for continuous real estate price increases are shifts in disposable income, the cost of credit and access to it, supply disruptions, and rising labor and raw construction material costs. According to experts, the real estate market is in for a difficult year because of a number of factors, including high mortgage rates, inflated home values, weaker buyer demand, and a recession. Selma Hepp, deputy chief economist at CoreLogic, claims that many prospective buyers are priced out of the market or hesitant to buy a home out of fear of home price drops because mortgage rates are at their highest level since the early 2000s and affordability is at a record low. The crisis may erupt in the near future if many buyers share the belief that there is widespread belief that today's robust price increases will continue. If many purchasers hold this opinion, purchases motivated by a fear of missing out may increase prices and raise hopes for significant increases in home values. Mortgage rates are at their highest point since the early 2000s. There is no evidence to suggest that the home market is about to implode, according to Lisa Sturdivant, chief economist at Bright MLS, despite the current state of uncertainty in both the economy and the property market. For a drop in home prices, like the one we experienced in 2008 for instance, we would need to see a sharp decline in demand and/or a sharp rise in supply. While many experts believe that a housing crash could be on the horizon, other experts don't believe that to be the case. Here's why. According to Jessica Lautz, Vice President of Research for the National Association of Realtors and the Chief Deputy Economist, said the housing market cannot compare to the intense spring home buying market from last year. Housing, however, is in high demand. The average home had 3 offers last month, and 1/3 of homes sold for more than they were originally listed for. In April, homes typically stayed on the market for 22 days, up from 17 days in April 2022, but down from 29 days in March. According to NAR, 73% of homes that sold in April were available for less than a month. According to the National Association of Realtors, inventory in the first quarter averaged 1,630,000 listings at any given time, down 40% from the first quarter of 2019, which was a year before the COVID-19 epidemic started. Due to the fact that 85% of mortgage holders are locked into interest rates below 5%, there is a restricted supply because current homeowners are deterred from selling their homes and purchasing new ones at the current high interest rates. Even if demand fell, property prices won't collapse because of the extremely low supply, according to Sturdivant. According to the National Association of Home Builders, NAHB, Wells Fargo Housing Market Index, HMI, which was released in May, builder confidence in the market for newly constructed single-family homes increased 5 points to 50 in May. For the first time since July 2022, confidence levels have reached the midpoint of 50, marking the 5th consecutive month of rising builder confidence. Builders who receive scores of over 50 consider the state of the market to be good as opposed to fair or poor. Even if there is a price adjustment, experts agree that it won't be as severe as the housing crisis of 2007 to 2009. So, will we experience the next major housing market crash soon? Only time will tell. Thank you for tuning in. Don't forget to hit the like button and subscribe to stay up to date on the world of economics. Until next time.